By the end of this video, you will understand what a value multiple is, why it's so useful, why everybody likes to look at it, how do you explain the numbers, and why I am actually not a fan of using valuation multiples. How's it going, world? Michael EJ here, helping you reach your financial goals and dreams by becoming the best investor that you can be. If you're new to the channel, how's it going? Mainly talking about the stock market here and offering differentiated advice. My mantra is, if you want to beat the market, you must be different in the market. So if you want to learn about being different, check out the channel, hit that subscribe button, like the video, and let's get started. So for all the newer investors out there, and maybe more advanced ones, we all know about valuation multiples. When you look up a stock, look up a company, they tell you mainly the PE multiple. What the PE multiple is, you probably see some other multiples in there, maybe price to sales, EV to EBITDA, different multiples out there. And the best way to actually think about a multiple is think about the inverse. Let's take price to earnings and just flip it to earnings yield. Instead of P divided by E, it's E divided by P. So for the market, long term, it trades about 16 times earnings, which if you flip over, the inverse of that is about 6%. Now think about that 6% as an interest rate. Think about it in terms of an interest rate. Now you're getting, you put $100 in the market and you're expecting 6%, so $6 back annually. So just think about it in terms of that. Now, for buying a bond, why are some bonds trading at 8, 9, 10% interest rates, whereas others are trading at 2, maybe 1, or maybe even less than 1% interest rates? Now for bonds, it's usually connected more to risk. High yield bonds, 10, 12%, or high yield loans, you're a risky person. I mean, you're giving a loan to somebody that's kind of risky. You're unsure about them. In the stock market, risk plays a role, but it's secondary to growth. Growth prospects kind of rule in terms of determining what a valuation multiple is. For example, on this channel, I pitch a lot of growth companies, growth names. A lot of them, I've looked at lately, trade around a 50 times PE or a 2% earnings yield. The market right now is about at a 4% earnings yield. I just pitched Amazon a couple of weeks ago and they're trading at a 300 times PE, 0.3% earnings yield. Now, what is that telling you? Like that is blowing your mind. Well, what that does tell you is that the market is pretty confident in Amazon's long-term growth prospects. Like they're high and they're probably going to happen. Like they see high growth, very high growth, and relatively low risk. That's what the multiple is telling you. I've talked about the 3 main questions you need to ask before buying a stock in another video, and I'll put it in the card. But a 4th question you need to ask is the value multiple justified? You always need to ask if the value multiple is justified. Why? Because although the multiple is determined primarily by risk and secondarily by, well, primarily by growth, secondarily by risk, there's other things that determine valuation multiples. Always keep in mind that the value multiple is the market's perception, the market's point of view, not your individual point of view, which is why you shouldn't use value multiples as a way to protect your downside. Because remember, it's driven mainly by growth. Next is risk, and then there's other things. A company in one industry, if the competitor's doing good, the market might think of it as a good thing, and your stock's gonna rise. Not because of what you did, but what the competitor did. They did good, so you might do good. Or it might think the opposite. It might think that competitor did good, so you're gonna do bad. You're gonna sting up the joint. So that can happen. Industry dynamics happens. I mean, I've talked about this and how the stock market really works. I put that in the card as well. There's different ways, different reasons why stocks go up and down, why valuation multiples are where they're at. And yes, primarily is growth, secondarily is risk, but there's a lot of different factors that are also in there, which is why you need to ask the question in every investment you do, is the multiple justified at this level? Now, it's tough to determine that if you're using multiples, it's tough to determine that if you're comparing one company's multiple to peers. It's very hard to do that. It gets a little bit easier depending on what multiple you use, however. The easier multiples nobody uses are price to sales, price to book, and a playoff of price to book called EV, the invested capital, enterprise value to invested capital. For those who don't know, enterprise value is the market cap, you add debt, you minus cash, and you subtract some other things. I'll probably make a video about that later in the future as well. And that's how you look at a business holistically. Now, like I mentioned before, the PE multiple, price to free cash flow, EV to EBITDA, they're connected to growth. That's the main thing. Price to sales and price to book and EV to IC is a little bit easier, mainly because you're looking at different things that are more tangible. So price to sales is connected more to a company's margins. So if a company has high margins, they're a high margin business, yeah, their price to sales might be high. Look at some of the companies that are out there trading at 4, 5, 6, 7 times price to sales, when the price to sales of the market historically is around 1.3, 1.5. It's because these stocks have very high margins. These companies have very high margins. So you just got to make sure that that check is there. Same thing with price to book and EV to IC. They're connected to, mainly, they're more of asset-based multiples. And all you got to do is look at the assets the company has and the return on investment. For EV to IC, look at returns on invested capital. For price to book, look at return on equity. If those numbers are very high, then yes, you're going to have a very high price to book. And you should. So those are the easy checks. The much tougher ones that depend on growth, your price to earnings mainly, it's much tougher to figure out because they fluctuate more. They fluctuate a lot more. So in terms of answering that question, if the multiple is justified, I would actually look at price to sales and price to book before I look at the price to earnings, because growth can happen for many different reasons, and stocks, what drives stocks prices changes for many different reasons. So if you want to understand the profitability of a company and maybe look at the earnings or maybe look at the free cash flow of a company, I actually suggest an intrinsic valuation method, looking deeper under the numbers, looking deeper under the hood. I will have a video coming up with that going forward and talk more about why I like intrinsic valuations more than multiples, because multiples there's a lot of noise. There's a lot of noise in that PE ratio. So just keep that in mind. When you ask that question, if the value multiple is justified, look more at price to sales and price to book, because PE can tell you a lot of things, but remember, it's market's perception, and the market can be a little moody, it can be a little cranky, it can be irrational. So don't depend on the market. Don't use the market as your downside. Don't use the value multiple as your downside. Just understand if the multiple is justified and keep moving along in your investment process. And that's what I have for you all today. Guys, if you just want to continue to look at the world differently and try to outperform the world, outperform the market, I'm your guy. Make sure to check out more videos on the channel. Remember, don't use value multiples as a way to measure risk. That's not the way. There's different ways to measure risk. Remember, it mainly tells you about growth, mainly in the PE ratio. Price to book is connected more to returns on equity. Price to sales connected more to margins. Keep that in mind. Is the multiple justified? Always ask, and I'll see you in the next video. Peace.